There seems to be some concern that the 2020 economic downturn will lead to another foreclosure crisis like the one we experienced after the housing crash a little over a decade ago. My name is Ryan Anderson with Lamacchia Realty. Did you take advantage of the CARES Act and all the mortgage forbearance options to help you get over this economic slump that we happen to find ourselves in? Then you need to pay attention to these tips and this helpful information that's going to help you navigate this current environment we're in. There's one major difference this time. We have a robust forbearance program. During the housing crash of 2006 to 2008, many homeowners felt they were forced to pay their mortgage despite their economic hardships that they were experiencing. There's absolutely no empathy for those challenges that those households were facing. What resulted from that lack of empathy? Foreclosures mounted. This time is different. There was an immediate understanding that homeowners were faced with a challenge not of their own making. The government quickly jumped in with a mortgage forbearance program that relieved the financial burden placed on many households. The program allowed many borrowers to suspend their monthly mortgage payments until the economic condition improved, and it was the right thing to do. So what happens when the mortgage forbearance programs expire? Some analysts are concerned that many homeowners will not be able to make up their back payments once the forbearance plan expires. They're concerned the situation will lead to an onslaught of foreclosures in this market. The banks and government learned a lot of challenges from what the country experienced during the housing crash. They don't want a surge of forbearances again, and for that reason, they put in place alternative ways homeowners can pay back their mortgage on money owned over an extended period of time. First option is you can refinance the amount that you have to repay, and it's for borrowers who still have strong credit, have good improved equity in their homes. They possibly had a higher interest rate at one point, but now want to capitalize on the lower interest rates that are actually out there. You should still have steady employment, no significant wage loss, and that will help you right there. You could do a repayment plan, pay it back in higher monthly payments, so you break it down and add it on to your monthly payment each month. It's for people who cannot reinstate using savings but have increased monthly income and do not want to use the deferral program. The deferral program simply shifts payments from what's owed now to moving it towards the end of the loan. So if you sell your home, that's when those payments are going to become due. And it's for borrowers who have lost income temporarily and have regained most or all of their income, but are not in a position to refinance due to their credit score, like so many Americans are right now. You can do a loan modification. A loan modification is going to be for households that have lost 20 to 30% of their overall income. And basically what that does is it takes your income and your debt to income ratios and everything that's valid right now, and it reconfigures your loan to match what you can actually financially afford. Another major difference is that unlike 2006 through 2008, homeowners are sitting on a record amount of home equity. And that will enable them to sell their homes and walk away with cash instead of going through foreclosures. Listen, I know it can be tough out there right now, and I just want you to know that there's plenty of help out there for you. But in order for us to take advantage of it, you need to ask.